So cash on cash is it's a pretty simplistic term. Is basically just it is the relativity in dollar amount for the amount of money out of pocket to acquire the asset versus the amount of money that I earn on the money spent. Okay, so basically, I'll go to a cash flow statement. So to buy this asset, you can see the out of pocket cost is the 1,775 out of pocket, right? The starting equity. Okay, the 177,500. Now, in this instance, I'm also not spending money to renovate it. Okay, there's not a budget for that. So basically, if there was, I would go to raise B, which I could basically I could plug in a number in here, and I could say, hey, I'm going to spend, let's just say, $50,000 renovating apartments or whatever. So now my out-of-pocket cost is $227,500. So I'm out of pocket $227,500. The starting equity is going to be a little bit different because this isn't calculating how I'm spending the $50,000. Okay. But what's important is the cash flow after debt service, right? Because you have your operating income at the top. You have your operating expenses, your taxes, your insurance, your utilities, how much it costs to operate the property. Then after your expenses, you have a net operating income. And the only last cost after that is your debt service, right? I have to pay my mortgage. So after you take your net operating income, after your mortgage, you have the cash flow, operating cash flow, after debt service, okay, which is basically what everyone likes to call is just actually that's actually your cash flow, okay? So when people talk about property, this is your actual cash flow. Now, cash on cash is just the relativity, that number, into the amount of money out of pocket. So if let's just say in this instance, this very small deal as an instance is only making $7,000 a year right here at the bottom, $6,800. Now, again, it's saying that we spent $177,500 and we're only making 7 G's. Right? So it's a very, very, sorry, let's go to summary. It's only 3% a year on my money. You can take that same calculation, the same $7,000. I could do it on a calculator, right? And you take your 6,800 or $7,000 and divide it into the 227.5. And that's how you have a cash on cash return. Now, I also like to know what my cash on cash year one is because it's very different of having cash on cash year one versus cash on cash overall, because sometimes you get into a deal and the deal is losing money day one because you have vacancies and you have to maybe buy it with hard money, right? Maybe you're buying a property that has some vacancy, you have to buy it with hard money. Like as an example, let's just say this guy he wants like, I don't know, $450, okay? But it's also going to cost $150 to renovate it because it's majorly vacant, okay? And the interest rate's not going to be 7, it's going to be 12. And we're going to get 80%. So now it's like we're losing money hand over fist on this deal, but the future value is 750. So we're still going to be in a decent place. It's not a horrible deal. Okay. You can see my operating cash flow year one sucks. Again, based on your income in the future, right? I have, in this case, it's a 6 family. I don't even remember what deal this was, but let's just say that, this is actually 0. But then we can say let's just say in 6 months to 1 year, I can get the value of each unit up to, give me a minute. Let me think. Let me say 1,500 a unit, say $9,000. Anyways, so this is going to calculate saying if I plug this in market price monthly, saying each unit of the 6 in this instance within the first 2 to 4 quarters, quarter to market. Okay. By the way, obviously practicing using this spreadsheet will help a lot because this is built on quarters, not months or years. This is saying between 6 months and a year, I can rent out each unit for $1,500. Right? So now it's saying like the future value of this asset's 900. This deal makes a lot of sense, but we are horribly negative year one. So my cash on cash year one might be different from the fact that it's still going to have a fantastic internal rate of return. Next term, real quick, stabilized yield. I'm sure that's maybe what you were thinking about as well.
That was what I didn't.
Okay.
Yeah, I didn't know that.
Stabilized yield, also pretty similar, but it's basically stating the total money it takes to acquire the deal. It's not just the money out of pocket. Cash on cash is only referred to the amount of money out of pocket. Stabilized yield is referred to the total amount of money to acquire the asset and all of the money I had to spend or we had to spend to renovate it or put into the property in total. So closing costs, renovations, and purchase price all together in relative terms to what we make on the deal, right? So this is saying once it's fully stabilized, so it's saying on this $54,000 in net operating income, okay? This is not after debt service. This is not cash flow, okay? But it's saying on my net operating income, this in relative terms to the total money I've spent to get to the 54 grand. So it's saying that my total out of pocket was, let's say, 450 plus the 40, right? That's 490 plus the 150. So we're at 490 plus 150 puts us at 640, and we're making 54 grand a year on the 640. Right. So that's where it comes up with the 8.5%. So basically big time investors, very, very seasoned people. OK, a lot of the bigger deals are sold based off of stabilized yield and equity multiples. They're very important terms. OK, so stabilized yield is, again, the total amount of money invested into the deal, purchase price, closing costs, and all renovations included on the future net income of this property, and those in relative terms. And now equity multiple. The equity multiple is essentially saying the total amount of equity or amount of money I come out of pocket. So in this case, 280, in regards to how much money I get back. So it includes paying myself back, which would be an equity multiple. If, like, let's say we did a deal and I invested 280 and I made 280 back, like total. So I made even, it would be 1-to-1. So that, not a good investment, right? Yeah. Thank God we didn't lose money, but we wouldn't say that's a good investment, right? Now, an equity multiple of 174 means I made 74% more than my money back. Okay. Now, remember, what's interesting though about equity multiple doesn't care about time horizon. Equity multiple can mean that you made 74% on your money, whether it's 1 year or 20 years. So it just means equity multiple is just the total return on capital divided into into 100, essentially. Okay, because it's basically taking, in this case, 280. The profit on this, total distributions on this deal, I guess, was the 486, and it's saying the 280 into 486 comes to around a 1.74% equity multiple. Okay, total investment out, total investment in. So profit, it's based off of the profit, right? Last one is internal rate of return.
Before you go there, the total distributions, what is that pulling from? Like, how is that number being calculated?
So this number is being calculated by 903 minus my closing costs, minus my loan replacement, gives me a total of 515. And this net proceeds after the sale is then just, because we can actually, this is a way better way to look at it right here at the very end. You just basically scroll to the bottom and you can see where all the numbers are going, right? So you can see that somebody invested, as an example, because again, like I said, this is built for private equity. So it's like when you're raising money, it'll tell you exactly how much distributions are supposed to be given out. Okay. So it'll actually say, it's actually very weird because this here, give me 1 second. Let's just do an equal. There we go. Much better. Okay. So now this should look different. Okay. Give me 1 second because it's saying we lost a bunch of money, which makes sense. Okay. Let me do one thing real fast. So the reason why this looks really weird is it's saying that we have 12% interest the entire time. So obviously we're not stupid and going to keep 12% interest all the time. We're going to refinance 1 year in at, let's just say, 7.5% interest at a cap rate of 7.5. Let's say a 65% loan to value. Now it's going to make a lot more sense because no one would ever stay there. There we go. Okay, because now this line means the starting, like the amount of money we have in the bank is actually positive. Anyway, so now it makes more sense. So essentially, this is here, like, the amount of money that'll be distributed to the investor, right, available for distribution, and this is what the investor will make. So it'll stay here that up to this point they've collected 34 grand in distributions because we have to obviously have some money in the checking account. We can't go below. We like to do 6 months worth of operating expenses or mortgage expenses because we're already calculating for more operating. But then they're saying that at the very end they get 500 back, 505,000. So the total amount of distributions would be the total, right? This entire line item here, the available for distributions. This entire line item is just being totaled, and you'll see that this number 534 is just the 505 plus the whatever, or the 500 plus the whatever. Does that make sense?
Yep.
Okay, cool. And then internal rate of return. Are you familiar with that? Okay, internal rate of return is a fancy way of saying how fast did I recoup or how fast did I make my money? Because it's like, you're familiar with like the stock market gives you an 8 to 10% a year return. So basically if you had, let's just say you invest $100, because internal rate of return just loves speed. It's all about how fast you can make the money. Because if you take $100 invested in the S&P 500 and it makes you 10% in 1 year, then it makes you $10 at the end of 12 months.
Yeah.
However, if you made the same $10, but you made it in a day versus making it in a year, your rate of return is not 10% anymore.
Yeah.
It's 10%, sped up to 1 day, right? So like the annualized rate of return, right? This is based off of annual. So it's an annualized rate of return on your money. So if you make hypothetically now let's take the $100,000 invested. Okay. We invest in a property for 100 grand. And we make our 100 grand back plus another 100. If we make it in 1 year, what's our rate of return? Annualized rate of return. If we invested 100 and we made $100,000 back, what's our rate of return?
100%.
100%. Yeah, we made 100% rate of return. Okay, very, very good deal. Okay, now if you made the same $100,000, but took you 2 years, what's your rate of return? Your analyzed rate of return?
50%.
50%. Great. Now, all that internal rate of return is doing is calculating that number based on the total amount of money I invested versus the amount of money I got back and how fast that occurred. So what's interesting is that this is exactly how you can see it in real time. So this deal is saying that if we bought it for 450, invested 150 into it, after all distributions, the refinance and everything, after the 20 is 20 quarters, that's 5 years. Okay, we're making a 33% rate of return on our money. Boy, what's cool, what's really cool about this is that you can actually play around with this number and say, okay, well, what if I sold it in 3 years? Oh, now it's a 50% rate of return on my money, right? And if I sold it in 2 years, it's 74% on my money per year, right? So you can play around with these numbers all day long. Now, obviously, like the biggest important thing is like your assumption on cap rate. Maybe it doesn't sell for a 6. What happens if it sells for an 8 cap? You can play around with those numbers. Now, obviously, this is a very good deal, and this doesn't happen all the time. But most of the time, it's not going to be this wonderful of a deal.